I looked at the stock because I haven't done that in a while. The stock is trading at a PE ratio, a forward PE ratio of 250. The stock is trading at a price to sales ratio of almost 90. Meaning,
we call this deep value.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Skippy and Doogles talk investing up in the house. Welcome, everybody. SkippyDoogles.com is where you go for all the goodness. Check it out. Seriously, if you have not gone there, do you not know what the internet is? Like, do you not know what the internet is?
Do you not know how busy our intern is putting content out there? I mean, come on.
And y'all can't even check out a website? Like, this is... I just thought better of you. That's all I'm saying. I thought better of you. We are going to start off today's episode talking about Kenvue. And Skippy, you've been hollering about the Kenvue train for a hot minute now. We're going to talk about Kenvue. Used to be a part of Johnson & Johnson. We're going to talk about that. And then we're going to hit on OpenAI. We're going to do that. Kenvue. How do you feel right now about Kenvue?
I can't not talk about this without a history lesson. So listen, young chaps, sit up and let me tell you how value investing used to work. Okay. In the 2010s, basically, I'd buy 5 to 8 stocks per year ish, and one or two of them would get an acquisition, would be acquired, and the stock would go up 40 to 60%, and you'd take your money and go home, and it was great. That was a meaningful part of my return, right?
Acquisition.
When I pitched Kenvue on the show as a research recommendation, it was exactly that. It was like, this is Tylenol and a bunch of other really premium brand like Band-Aid, Benadryl, Motrin. This stuff is not leaving your supermarket anytime soon.
And by the way, if y'all are like, wait, when did Skippy pitch this as a research recommendation? You would not know that unless you are a premium listener. SkippyDoogles at supercast.com, because we did that on the premium episode. So just in case people are confused about that. All right, continue. Band-Aids, okay. Tylenol.
So the things at $14-15 a share, and I'm just going, guys, take a look. If you want to own these premium brands at basically historically low valuations, take a look. That appears to have worked out great for me, Doogles, because what happened this week is Kimberly Clark, of Kleenex and Huggies fame, another one of these companies, said, hey, Kenvue, I know you're at $14 a share. I'd like to pay $21 a share for you. This is amazing. Great. So applause. Great. I'm happy. But here's the really interesting story.
So the stock is now trading at $21 a share?
Not at all. Cash and stock deal. I won't go into too much complexities, but $21 a share, and $3 of that is straight cash, homie, right?
Yep, that's right.
What the market hates Kenvue so much right now that when the acquisition is announced, Kimberly Clark's stock goes down 15%. They say, "Oh no, you want to buy that hot garbage? We're bringing you down. You're not climbing out of this and being like, I got Tylenol now. We're bringing you into the riffraff." So yes, it's currently at $17 a share. Who knows? I don't think I'll sit around and wait for the acquisition to actually take place.
If you were a public traded company and you announced you were buying autism, would people be a fan of that or not?
Those are lies, Doogles. To me, it's so incredibly interesting because Kimberly Clark now is effectively it's been caught up in the same concerns without the legal stuff that Kenvue has. It's just these are premium price consumer staples, and everyone says McDonald's says the low income customer is struggling and that they're buying less food. There's all this data out there that implies that the recession is already here for a certain group of people in the K-shaped economy. So people go, that's bad for Huggies. That's bad for Kleenex because you buy the cheap stuff. That's bad for Tylenol because you buy the knockoff stuff. That's been the hypothesis. And now they're just more premium brands together. So it'll be very interesting to see where that goes. I find it fascinating. I mean, it kind of made me chuckle on multiple fronts this week. One, I was like, yay. Then I was like, wow, the market hates this more than I actually realized they hated it, which is why I was trading at historic lows.
How do you think? Well, actually, two questions around this, both around Buffett. The question I was going to ask is, how do you think Warren Buffett felt when Kimberly Clark got Tylenol and not him? And do you think Buffett was a part of the conversation?
Okay, so this is fascinating because back in September, I was hollering that I expected Buffett to buy Kenvue. It's like such an easy Buffett play. Buffett's sitting around taking Tylenol for 100 years, and then he sees the thing super cheap, and he's not going to buy. He doesn't want to have Band-Aids in his portfolio. I mean, to me, this was just like it had Buffett written all over it. That's another interesting thing about the Kimberly Clark acquisition, because clearly I think there's a little bit of a bidding war happening behind the scenes, right?
Probably.
And Kenvue gets to pick where they want to sell it. But also, for Kenvue's executives, I am disappointed in. I understood why they took the deal, but I don't think $21 is fair value, $21 per share. That's just my personal opinion. So it is a little bit of a panic move on their behalf.
There's board pressure. There's got to be board pressure on this. I mean, the fact that this was spun off from Johnson & Johnson was the beginning of this. Like, there's just so much pressure around that business in general. And now you have when you look into the future and you look at like the White House pressure that's coming, that was the autism conversation, the making over there was when the White House is coming out and saying that Tylenol causes autism. Like, there's that pressure, and you're like, okay, we got 3 more years of potentially that. And you've got board pressure saying you got to make money, homie, but the market has the worst case scenario outlined. The best case for your stock is the worst case scenario, according to the market right now. So much pressure.
Yeah. So basically the board said they don't want to deal with lawsuits for 3 or 4 years and just get caught in the riffraff and get left behind, which I understand. But if you're a strong and creative management team and you have these 100+ year brands, and let's just correct that, like, there's an acquisition of autism, which no scientific body has said has any credible evidence, right? Yeah. So I feel like their PR team and their ability to go on the attack and actually get facts out there is greatly undermined. And that, to me, that tells you all you need to know about the management team, and that's why you end up where you wind up.
Yeah.
The reason I was interested when it was this cheap is because I felt like the management team could be below average, I'll call it. Sorry, not trying to throw shade. Hopefully no one listens from Kenvue. But and you could still have a pretty nice outcome in terms of the return on your investment. So, yeah, what I wish would have happened is they would have aggressively played the long game and rebuilt the company with a pristine balance sheet and a bunch of lawsuit wins where it's worth $25 to $30 a share. That's not going to happen. Right. So now, whatever, I'll take a few bucks and move on to the next one.
It feels utterly ridiculous to me, but this is a sign of where things are right now. Utterly ridiculous to me that this team, the board and management team, can look at a 50% premium and say that's the best case scenario we think we could see over the next few years. Like, it's outrageous.
You're trying to get me fired up now. Sorry, this is from memory, but when as little as like 9 months ago, maybe 12 months ago, the stock was trading at $25 a share.
Yeah.
To say
you've seen
21 is the top end is nonsensical. It doesn't make, but whatever. It tells you what's happening with the board and their concerns over losing the PR campaign, which they've clearly lost. I mean, the Texas Attorney General now wants them to stop paying dividends because he thinks there's some sort of concern over their handling of things. Lawsuits are an interesting part of the investing piece. Maybe don't get talked about enough.
The biggest irony for me, the biggest nerd irony for me, is as a student of business and business history, which both of us are, Tylenol specifically is a case study that is talked about from the perspective of having like business integrity, having the leadership that is willing to fight and to do what's right. That is like Tylenol. That's the case study. Everyone always goes back to Tylenol. It's about your principles. It's about the Johnson & Johnson credo. You know, like that Tylenol. And now the way it ends, like the way that case study now ends is with a whimper.
Is they gave up. Doogles, correct me on the facts, but what you're referring to here, just with the listeners, is this the 80s?
Yeah, early 80s. Yeah.
there is a contamination issue, and everyone goes,
Yeah,
"Oh
someone's
my
putting
goodness!" Like, it
cyanide.
basically is,
Someone is putting cyanide in Tylenol capsules.
and the response is from Johnson and Johnson is epically good. It is, we're pulling everything off the shelves.
Yep,
we're adding
right.
additional safety measures. We're like it cost them tons of money in the short term and built this credibility around the brand in the long term that says, even though I can buy acetaminophen here and Tylenol here, and the one has a 40% premium or whatever, it says, I know that this company has my back in a case that is for medicine that is really important for me and my family. And in a lot of cases, I'm willing to pay that premium simply for the brand, because the brand has this incredible reputation of protecting families, doing what's right by people in the worst times. And now, they just gave up.
Mm-hmm. Yeah, that's it. Someone was literally like, everyone knew it, poisoning people through your product. And your response was to pull everything, have integrity, bet your company's future effectively on your ability to uphold your standards.
Yes.
Now, today, a lie was put out there, and you went, sell everything. We're done. Sell everything.
You let the stock market, you let the bad PR crater your stock price. You didn't fight back, and you went out with a whimper. Yeah. Impressive work.
Clap, 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 clap. That's all I'm saying.
I told you we had to keep this episode upbeat, but I have a feeling this might continue down the train.
Wait, that was the upbeat part of our episode?
I'm going to make this next part upbeat. But when we're going to end up talking more about management teams, there is a very interesting approach happening with the most buzzworthy company in the world right now, which is OpenAI. And
never heard of
weeks ago on this very podcast, we said, we don't know where this money comes from to spend $1.4 trillion in future obligations with all these crazy deals they've signed. And it seems like at least the financial and business community also really wonders about the same question. And it's been asked over and over. And the management team of that company has not done a great job of answering this question.
I feel you must have missed it, because there was an interview with Sam Altman, the CEO of OpenAI, and he explained in excruciating detail how they were going to generate every dollar. Did you not see this interview? Here, let me just play you. I'm just going to play you a little clip, because I can't do it justice. There's so much detail in this that I can never do it justice. I'm just going to play you this clip right here.
Criticism,
First
Sam.
of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer. I just, enough. Like, people are, I think there's a lot of people who would love to buy OpenAI shares. I don't think you would,
including myself. Including myself.
People who talk with a lot of like breathless concern about our compute stuff or whatever that would be thrilled to buy shares.
Now do you have anything to say? Because I feel like he just explained it all.
It needs a little more context. He was asked basically how you cover these future commitments on $1.4 trillion worth of future spend. It's like over the next 7 years, when your company does $13 billion in revenue. And he laughs, this like dismissive laugh, says it's well more than that. We're going to talk about what it actually is today. And then just says, people want to buy our shares, which is, we might as well go to crypto land here, Doogles. It's like numbers go up. Like, don't worry, when Bitcoin's worth $2 trillion a coin, everything will take care of it. So it could be Michael Saylor for all I care. There is some truth to people want to own your company, and you think there's an IPO coming, and you think you can raise. The optimistic estimates is they might be able to raise $100 billion from an IPO. Again, if the music doesn't stop in the next 2 years, that's still much less than a tenth of the 1.4 trillion in outlays that they have.
And here's the thing. These are the times where, for me, so Brad Gerstner was on this, and Satya Nadella was on this. And the person that said, from that clip, I want to buy more of your shares if you're going to sell them, that was Brad Gerstner. So much respect for him over his career as an investor. And over the last month-ish, I've been like, dude, what are you saying? Stop it. Like, just stop it. Because I'm not saying he's not a smart guy, blah, 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 but I'm just like, he is so defensive around this situation. I want to call it a bubble, but this situation, that I'm like, either you were going to be right or there's going to be all the eggs on your face. Like all the eggs.
I haven't followed that. I haven't followed his latest talk track. But let me say this, a more really important context. He's asking Sam this question as a friend, as an investor. This is supposed to be a softball for Sam to have an easy answer. And
Yes.
when you get that defensive and give a complete non-answer, it raises a bunch of issues. So then in the next 5 days, the CFO of OpenAI
This is classic.
casually mentions government backstops for some of the spending they're doing and talks about a national security issue. That quickly blows up again in the nerd finance community that I don't expect our average listener to follow.
No. And I'll say, so Sarah Fryer is their CFO. Great respect for her as well. Used to be the CFO of Square. Great track record, incredible in finance. Now has herself in a pickle. Continue.
I love that you're throwing out great track records here. This is not what happened this week is not good. So
No, it's not.
let's have some recency bias. She attempts to backtrack that. A day or two later, Sam writes a tweet that's basically the length of Ulysses,
Ulysses.
backtracking that. And kind of says, no, we never want a government backstop, but we think that it's probably a national security issue, and we're the leading player. And so, yeah, how about a government backstop? I mean,
And this is, sorry, but the reason I brought up the track record, so when I met Sarah Fryer was when she was back at Square. This was probably in like 2013, something like that, 2014, somewhere around that time. She is legit. Like, awesome, legit. So when she put that out there, I went, this is the truth. That is how, in my mind, that is the level of credibility that I have with her. When she said that, I went, she would not say that. Like, she's not going to make something up.
so I love your personal history here because that's important context. It tells you the conversations that happen behind the scenes. It tells you, and again, your respect for her as like a numbers guru tells you that when they're looking at their spreadsheets and signing these contracts, their strategy is very unique. I think my frustration is not necessarily with her, it's with the company in general.
Yep.
And I want to compare and contrast to a competitor of theirs, Anthropic. Anthropic, who has had great momentum with enterprise providers. So you might not hear about it as much in terms of the person replacing their Google search or anything. It's kind of behind the scenes. If you're not a fairly sophisticated AI user, you might not even hear about it.
Claude's great.
OpenAI plans to spend over $100 billion and fingers crossed, Doogles, become profitable in 2030.
Yep. Yes, sir.
5+ years from now. Anthropic needs to spend $6 billion next couple years, $6 billion in losses, and thinks they can be cash flow positive by 2027. Then they think they could be significantly cash flow positive. I'm talking like almost $20 billion worth in 2028. Do financial projections ever come true for startups like this? No. But is that a much more typical plan that you would communicate to your investors and to the street? Like, here's our clear path to profitability, and it's 2 to 3 years out, and we can talk through exactly how we make that happen. A very reasonable, very typical plan that gets me excited about potentially putting my money. OpenAI's smart people, good company, is just garbage. Like, no one's ever done this before.
Sam Altman's situation reminds me of, so I'm a startup guy, for those that have not listened, or a bunch of startups. There's a head of product at one point that worked for a company I was at. And when people would bring features to him that he had, what I learned, no interest in actually doing, he would go, oh yeah, absolutely. July of, and then he would name 2 years from then. He goes, that's going to be delivered in July of whatever.
We'll put it on the roadmap.
Yeah. It's on the roadmap. Yeah. And he'd be like, oh yeah, July. That's going to be ready in July. And it was specific enough for people to be like, great. He's got on the roadmap. But when I would talk to him about it, he goes, oh yeah, that's just the date I give. Yeah. There's like, I didn't even write that down. Like, I didn't even consider that. That feels like the situation. And there's so much in the last couple months that has reminded me of scenes from The Big Short. Love that movie. Love that movie. I'm gonna play a little soundbite for you here from The Big Short that was brought up as I was figuring out or listening to Sam Altman talk here.
short everything that guy has touched. I want $500 million more swaps.
That's it. That's all I got to play for you. Like,
is this in reference to our good friend Sam here?
yes. Yeah, it's like it's the kind of conversation. If I had that conversation, I'd be like, oh, great, cool. I got to interview Sam Altman. It was wonderful. I would leave and be like, Skippy, short everything that guy is about right now. Now, I'm not, for everyone listening right now, I'm not shorting everything. I'm not saying that that's what I'm doing in the market right now. But that is what that inspires in me. Like, what it does not inspire in me is any confidence that success is around the corner. Because to go back to what I was incredibly sarcastic about before, he does not give excruciating detail about how he's going to create this money. He just says, if you don't like it, short it. In fact, later in that conversation, he says, I don't usually wish that we were public, but right now I wish that we were public so that he could crush the short sellers. Like, how is that a defense for your business?
Okay, so just without us even throwing shade, just reset. I'm asking our listeners to pretend you can invest in either Anthropic or OpenAI, and maybe throw in a third name. Maybe a third name is like make 5% in money market bonds, and listen to those two stories, and then understand that OpenAI is another key part of their story, including government backstops for their debt, is also to IPO at around $1 trillion of value, which no company in the history of the world had ever exceeded until Apple exceeded that in 2018. So literally, they think they are one of the most valuable companies in the world today when all they do is light cash on fire.
And this would seem ridiculous to me outside of the fact that one of the people on the short list to become the next Fed chair is one of the co-authors of Dow 36,000. Like, everything is a joke at this point when it comes to financial markets.
So you can have that. You can assume everything goes perfect. And 1.4 trillion appears out of thin air. You can go with a company with very similar technology in Anthropic, who is clearly on the path to profitability, or at least their management team isn't making up lies about it. Or you can buy some money market notes.
Yeah.
To me, the choice never ends up with, can I write OpenAI a check?
And folks, what's really important to think about and realize in this conversation is that it's actually this is not a binary situation of, does what Sam Altman says become true or not? That's not it. That's not the whole story. The whole story is, as an investor, what's important is that you're investing in the future to get price appreciation plus dividends, et cetera. And the valuation of OpenAI is based on this becoming true. So what we're saying is, if this becomes true, if this like fairy tale becomes true, which this might happen, like they might pull it off. If that becomes true, you get the current valuation.
Yes. Yeah.
So you're betting
no margin
everything.
Of safety here.
No, exactly. Like what you're saying is, if all of this that we're saying is like, it's a long shot, and I hope it happens. If that becomes true, cool. You make 0%.
You do not lose money in that.
Yeah.
There's one more thing I have to tie in here, because Palantir's CEO was interviewed this week and said almost the exact same thing. Palantir is a publicly traded company, Denver-based, by the way. Shout out.
There we go.
That he was so mad because Michael Burry has officially shorted his stock, or bought puts against his stock. Basically made a bet against his stock for the novice.
Speaking of the Big Short,
there.
Yeah, there we
Speaking of the Big Short, Michael Burry of Big Short fame has bet against this stock. I looked at the stock because I haven't done that in a while. The stock is trading at a PE ratio, a forward PE ratio of 250. The stock is trading at a price to sales ratio of almost 90. Meaning,
we call this deep value.
Meaning, if they kept revenues where they are today, and granted it's growing, so that's unlikely, and printed and did that for the next 90 years and took 100% of their sales and gave it back to shareholders, that's how their shareholders would break even. They just have to sit around for 90 years and nothing bad has to happen.
Reasonable.
I can't recall. I mean, can you recall? I can't recall seeing a stock at these multiples ever. This is a pretty easy, pretty reasonable thing to bet against. The funny part was in this interview, his defensiveness. It was very similar to Sam Altman's in terms of, I can't wait. Like, this is motivation, and I can't wait to make people like Michael Burry and anyone who bets against me basically cry in their cereal. It's a weird response. Whether I think I'd say, well, the valuations are pretty insane, and I understand why someone would bet against the valuation. I think the fundamentals of our business are strong, and we will continue to build a great business, but that's a lumpy road. I don't think you have to say, no one's allowed to bet against me ever.
And here's why both of these are incredibly important in my eyes. So Alex Karp, CEO of Palantir, Sam Altman, CEO of OpenAI. These are two individuals that I don't know either one of them, but I publicly have seen them give like real answers to questions. Like they've said, I don't know, or we're going to figure this out, or like they've done that historically. And they are both at the point where like that's not a safe answer. And they don't know.
But I don't think Alex has to be. So I think Sam
has to be. He has to be.
Is caught up in there's a business strategy happening behind the scenes that either is we're going to be too big to fail, or there's some reason, again, which Sarah knows intimately well, there's something behind the scenes that says this is our best strategy, even though it's a long shot. Like, we have to become the world's dominant player in AI, and we have to become the name brand, the Kleenex of all the things that happen in AI. Yep. We need huge contracts. Like, that's the only path forward for them. It's not the path I would have taken, but they've decided to take that. So then you have to, I want to say lie, but I'll say like be liberal with the truth to sell that story in order for it to come true over the next 5 years. I think that's a decision they've made, and whatever, it is what it is. Alex has like one of the best performing stocks in recent history by a mile. I mean, this
numbers are phenomenal.
It's a very exciting company, which is why it trades at these valuations.
Yes, by the way, their fundamentals are incredible.
Like growth rates and stuff. Their rule of 40 is
like rule of
14.
Incredible.
Right? So incredible company that is trading at insane valuations. I really don't understand the ability to pull a Jeff Bezos and be like, the stock price is the stock price. I totally understand why people could say the stock price got over its skis. I think we're an incredible company, and I think we'll prove that over the next decade. Yep. It's just noise. That's the right answer to that question 100 times out of 100, and that was not the answer we got, which leads to more concern.
Yeah. And this is similar. We've said this a bunch of times on this pod. We believe in AI, Palantir, great fundamentals, etc. You have to separate in your mind something being phenomenal and it being worth the price. That's important for investing because those two things are separate. Like if somebody, let's say Skippy, you're applying for a job, you love this job, your dream job, you put me down as a reference. They called me, I was like, oh, dude, he's brilliant, he's creative, great team player, blah, blah, blah. And then they came back and they said, oh, we're going to pay him $1 trillion a year. I'd be like, whoa, hold on. And they go, well, you don't think he's brilliant and creative? No, all those things are true. And
he's not worth $1 trillion.
He's not worth $1 trillion. Like both things can be true. You can be an incredible organization and you can be important for the future and not worth the price people are paying.
It's a great example. We'll tie back to another thing. When I'm intrigued with Kenvue and Tylenol, it was because it was at $14 a share, not because it was at $100 a share.
Yes,
and I could have the same belief in the power of Tylenol's brand. And when it's trading at $100 a share, I could be laughing at the valuation and not understanding why people would ever pay $100 a share for it. That's what's happening here with really both those companies. It's like you make a great product, you're a great company. I just don't believe. I believe your current price is disconnected from your true value. Mm-hmm. I've been wrong before, plenty of times.
Oh yeah, plenty of times. I'm going to make what could be a brief, we'll see, transition over to a topic that's related. There was a Wall Street Journal piece this past week. The title is Private Credit Earnings Ease Investor Concern Over Asset Classes Health. Okay. On here a few times, I have personally brought up private credit. And we've discussed it in examples as well. Like when we discussed the First Brands piece, that was private credit. The difference, if you don't know what private credit means, private credit is debt that comes out not from banks, to put it simply. Mm-hmm. So banks will give out loans, or you can have like a hedge fund loan you something or whatever, but it's just not a bank loaning you. That's private credit. So we have brought up private credit here, either through examples like First Brands, or in general saying like this whole private credit thing could be I can't think of a word that means like a whole bunch of Kahlui put together.
Bank guidelines around credit are pretty stringent and strict and require a lot of regulation. And so the companies that happen to not be Microsoft or Apple, that maybe have less stellar balance sheets and still want to find debt, go to other places and they pay higher rates. And they shouldn't, but they do have less diligence around writing that credit. And so every time we've done that in the past 400 years where we've said, instead of follow the traditional model that's regulated heavily by the government, go somewhere else. That pocket works for a while, typically has really good returns for a while, which means more people flood the space, which means lending standards get relaxed even more, and then it blows up. So I'm just providing that history.
And this is similar. I'm going to use a similar line to what we just talked about. These things are not binary, good or bad. It's just when you go off of a standard path, you should question, like, is this worth it? Is it the right? Because when you go off a standard path, there should be a reason why you're going off the standard path. Kind of like what we were saying before. You have to hold both, that a company can be great and not worth the price. Both those things can be true. It could be true that a path is not necessarily good or bad.
I mean,
here's the deal.
I'm going to push back a little.
No, hold on. Let me just, we talked. If you are an individual and you're like, well, I don't really have my credit card can't do it, and like a bank won't give me a loan, so let me mortgage my house to pay for it. That does not mean that that's necessarily always bad. It just means you should be like, there should be a good reason for it. Like you should have a really good reason for it. Now push back.
No,
I wanted to feel the fire a little more.
Like what you're saying here is, oh well, yeah. If you're trying, you work at McDonald's, but you want to buy a brand new $70,000 car, and the car dealership says, "Sorry, we don't have financing for that," and then you sneakily go to the subprime lender, and you're calling that a unique path. No, it means the numbers don't pencil. And the only way someone's going to give you that number is like a predatory loan with a 20% interest rate.
Yeah,
that's just a bad idea.
That's a bad idea. What I'm saying is, though, if you're NVIDIA a couple years ago and you have billions, tens of billions, hundreds of billions of dollars that people are trying to give to you, and you go, oh, we actually just need 3 weeks of financing, you might have to go through a unique path. It's just a rare occurrence. It's a rare, very rare occurrence where you should do these kinds of things. So the situation you just named, you should not do that. But there are, if you're like Elon Musk, maybe it's fine because you could lose $20 billion. It doesn't even matter. That's all I'm saying.
We're just going to disagree about that point because
we're going to disagree to disagree. We're just going to disagree to disagree.
Tell me about private credit. Tell me about, shockingly, it's no issue, even though we're seeing lots of bankruptcy that was poor due diligence.
Why are you putting words in my mouth? It's unsanitary for you to put words in my mouth. So the title of this piece, again, Private Credit Earnings Ease Investor Concern Over Asset Classes Health. So the reason I'm saying that again is because I've been like, private credit is about to be a problem if it's not already, and we just don't even know about it. So I read the title for this piece and went, oh, I'm about to read this, and it's going to ease my concern. I wanted it to ease my concern because that's what it promised. So what I was specifically looking for was how private credit is actually giving money to folks that can easily pay that money back, because that's the only thing that's going to ease my concerns. When it comes to credit, you give out the credit, you get paid back. That eases my
that's
concern.
how lending works.
But similar to the conversation we were just having about OpenAI, the way that this eased concerns was they are making money. Their stocks are up. Their earnings are up. I'm reading this and I'm like, Wait, my concern wasn't that they weren't going to make money. My concern is that people won't be able to pay them back. And there's nowhere in here. And the central figure here is the CEO of Apollo. No one's giving answers at this point. No one is giving any answers.
Well, I mean, maybe they can sell some stock and put it in their distressed debt bucket for all the bankruptcies that are coming their way. There we go. Problem solved.
And the CEO of Apollo in here, he says that what's happening, people are putting more money into private credit because they are coming out of equity, which also does not give me any faith. He's like, it's fine because the money is coming out of equity. Okay, cool. And this was love Howard Marks. We talk about Howard Marks all the time. I'm going to reference his most recent memo. I'm not going to say that you should read it. Like, I'm not going to say that. It's like, I don't think there's much point in reading it, but I love that he wrote it because I just like that his hand still works because Howard Marks is brilliant. Howard Marks going out on top. Love it. Sold Oaktree. You confirmed your $1 billion. Love it. The title of this, Cockroaches in the Coal Mine. And so he plays on two different idioms. One is what Jamie Dimon recently brought up was when he was talking about first brands. Jamie Dimon said, if you see one cockroach, there are probably more. And he just meant like when there's one bad situation, there's likely a bunch more that's going to come. That's the cockroach part. The coal mine goes back to canary in a coal mine. I think everyone probably knows that. Where like when you see the hint of something, kind of the same thing. People in the coal mines used to bring a canary to see if there was gas. If the canary died, they wouldn't go in. So he's basically saying like this is the cockroach situation happening in the coal mine. Okay. The fact that he wrote this is all I really have to talk about. Is he's just like he is the credit man. Howard Marks is the debt guy. He does not know distressed debt. He does not know equity. He's like when people ask him like what's happening in the stock market, he goes, "Is there a stock market? I'm not even familiar with this thing called the stock market." He doesn't invest in the stock market.
You're exaggerating a little there.
But he's a debt guy. So him writing about what's happening right now in debt is like just by itself an important thing. He kind of says like there's still money to be made in debt. And I'll also bring up what's not in here is the fact that he, as I just mentioned, he just sold his company. So you take away what you will from that. But if I was like, dude, Kenvue, phenomenal stock. I just sold all of it. You should probably be wary.
You might follow someone's actions rather than their words. I mean, someone else will make lots of money in distressed debt in this next down cycle.
And that someone should be you. It
just probably won't be Howard Marks.
That someone should be you. This is quite a time. It's kind of phenomenal because this is the first time that I've been of like my age and maturity in investing to experience a time like this. Like when the .com situation was going on, even in 2008, I was actually like in the markets. So that was a little bit the .com. I was just experiencing it as like a consumer, whatever. But 2008, I was in the markets, but I wasn't like a seasoned investor at that point. Right. I call it. I was an investor. I was very interested in it, et cetera. This is the first time I've been able to like just see everything and go, that's how it happens.
I mean, if the OpenAI projections come true, it will be 1 in a million type, maybe 1 in 10,000 type thing. I'll try and not be super hyperbolic. Listen, the NVIDIA performance in the past 5 years, in my eyes, is like at least 1 in 1,000 type thing.
Yeah,
they are the perfect picks and shovels for this gold movement, and what they've done is absolutely incredible. And basically, no other company has done that in the past 100 years.
Yeah, that's true.
I don't think that's likely to happen with OpenAI, but we'll get to watch.
We will get to watch. And I hope it happens. But as I said before, even if it does happen, the stock is probably worth half of what we're talking about right now.
Or like 20%, maybe 10%. I mean, it's bonkers how that trillions of dollars get thrown around like it's nothing when people, I truly don't think, understand the number of zeros there.
We can't count that high.
Sorry. The last thing to put a bow on this, we didn't even talk about the fact that OpenAI changed their corporate structure this week, that Microsoft formally owns 27% of the equity and still gets a revenue share. Like, even if...
Oh, I didn't realize it was
both.
It's both?
Yeah. Yes. Yeah,
Wow.
listen to the full podcast on that BG2 podcast.
So
'cause they break down some
Satya is
details.
like great.
Satya
He does
is
not.
laughing.
It's
Satya
all upside.
laughed during that clip. He
all
completely
upside.
laughed because he turned basically a $10 billion investment in OpenAI already into roughly $130 billion, and he still gets some proprietary technology on his cloud platform and a revenue share. Satya is laughing.
That is brilliant. So from Satya's perspective, worst case scenario is they lose 10 billion, which like they did yesterday, accidentally, and like it doesn't matter.
Mhm.
That's the best case scenario is infinite. That is asymmetric upside that you should aim for, people.
And another interesting thing is if there are struggles with OpenAI's projections, and it turns out that they can't fulfill any of these, very few of these contracts that they've signed, who's the natural friend that can come in and rescue them? Maybe it's a company that's already worth more than $4 trillion that has unique, diverse revenue streams and a great use case for AI. Like, what he did is brilliant.
Yeah,
Absolutely.
it's brilliant. It's brilliant. Tim Cook falls in this category too, but it's very, very different. I view him as one of the, if not the most brilliant CEO of these last 20 years. Satya took the foundation of what Microsoft was at that point and has made lemonade out of, I can't call it what it had lemons, but like the market was viewing it as lemons, independent of whatever it was. The market was looking at what Steve Ballmer did and calling it lemons. I'm not going to judge what Steve Ballmer did, but they were calling it lemons. And he has created a behemoth, a re-behemoth, because it was already behemouthed. So he's re-behemouthed it. Y'all can use that. That's trademarked, but y'all can use it. I'm giving you permission. Re-behemoth. He's created some like real gold. It's pretty amazing.
Yep. All right, we got to wrap. So that's the state of things today, guys. Everyone with a skin in the game that has no choice but to say that private credit is great or that OpenAI can easily find $1 trillion is saying that. And I think it's fair to say we have some concerns. That's okay.
Yeah. Actually, I only have one
We'll watch
concern.
and learn.
I only have one concern, is that it's all going to fall apart. That's my only concern.
We'll catch you guys next week. Again, all thanks for the show, skippydoogles.com.
Thank you.